IBM stock is up 33% over the past 6 months. I've been holding this stock for a while longer, so I'm up about 10% right now in my shares, and I'm still collecting this great dividend yield of almost 5% on top of that. So today I want to take a look at a few financial metrics as well as IBM's Q1 2021 earnings and give you my thoughts on the company. So if you've been following the channel, you'll know that I recently did a second reading of the book One Up on Wall Street by Peter Lynch, and I made a few videos on it. Definitely check those out after if you're interested. I'm going to do my best today to analyze the company of IBM from Peter Lynch's perspective and what he would think of the company. This is a company that's in the midst of a major turnaround right now, and being that it is such a large company, it's going to take a while. I'm not expecting major changes overnight, but I do think that the ship is turning around and it's heading in the right direction. So a few months back, IBM announced it was spinning off its managed services division so that IBM can focus on the most profitable segments of the business, which mainly have to do with cloud as well as AI and quantum computing. Now, IBM's PE ratio currently sits a little under 24, making it much more cheaply valued or closer to fair value than some of its big competitors like Microsoft, Amazon, and the likes. If we take a quick look at the Q1 2021 earnings here, you see that their cloud and cognitive software segment brings in almost a third of their revenue at $5.4 billion. And not only is it a huge revenue driver, but it's also a segment that has a very, very high profit margin. As you can see, the gross profit margin on the cloud and cognitive software segment is 76%, which is double or more some of these other segments, as you can see. So you may ask, how is the company supposed to be turning around? It's ridding itself of these less profitable divisions. This way, IBM can focus on the cloud and these segments that are much more profitable, and the second company, which is going to be called Kyndryl, will take over the less profitable segments. So this will help IBM get back to being a growth story, I believe, in the long run. So as you can see, the company's expenses were also down from the previous quarter, year over year. So in 2020, almost $8 billion in expenses versus, let's say, $7.3 billion now. So this is another positive sign. You want to see a company that's in the midst of turning around, increasing profit margins as well as cutting costs. And I think we're going to see this trend continue. Now, it's not a drastic difference, but as I said earlier, it's a very big company. It's not going to happen overnight. It's going to be a gradual process. Now, IBM has about $150 billion in assets, down a little bit from last year at $155 billion, but they used money to pay down some debt. So as you can see, their total liabilities are $127 billion. Last year was $135 billion. They were able to pay down about $3 billion of this long-term debt, it looks like, which went from $54 billion to $51 billion. Another good sign. You want to see this debt is probably one of the things to really keep an eye on, because if the debt gets out of hand, it's going to be a big problem for the company. So the debt, I'd say, is definitely a risk for this company, but I think that for the time being, as long as they continue to even gradually increase profits and cut costs, they're going to pay down this debt and then they can get back to growing. But if the opposite was occurring here, if this debt were to keep creeping up and the profits were not, then this would be a red flag. So definitely something to monitor, especially the long-term debt. So the company brought in almost $11 billion in free cash flow over the past 12 months, ended March 31st. And they do have a lot of expenses that they're paying for here. Obviously the dividend, a lot of that money is going toward paying this dividend, which is pretty high. And it will be interesting to see what happens to the dividend once the company spins off. Are those less profitable divisions going to be able to sustain this dividend without the high profit margins from cloud? Probably not, and I wouldn't be surprised to see if the new IBM pays no dividend, as they're going to want to, be reinvesting this money in the business and growing. So some highlights from the CEO. Krishna said, "We are confident we can achieve full-year revenue growth and meet our adjusted free cash flow target in 2021. So it'll be interesting if they stay on this current path and they're able to achieve those goals. Definitely a story you want to keep your eyes on. So cloud revenue grew 18%. So the cloud revenue was up 34% year over year. So looking at IBM from Peter Lynch's perspective and as a turnaround play, Lynch loved a good turnaround story. And he would often buy stocks that were in, out of favor enterprises. Now, I don't really own many other turnaround plays. I don't think I could really categorize any of the other companies that I own as a turnaround play. So that's another reason why I really like IBM. I think it brings some important diversity to my portfolio. In the Peter Lynch videos I made, I talked about there's 6 different categories that Lynch puts stocks in. Turnarounds is one. Obviously, your high growth plays, the slow growers, stalwarts, cyclical industries, as well as asset plays. So trying to own as many of these as you can is a smart way to diversify. Instead of let's say, diversifying across different industries that you don't understand just for diversity's sake. That would not be a smart move. But if you structure your portfolio in this way, then no matter what kind of market you're in, unless the world is ending, a couple of these industries will probably be thriving at least, and then you can kind of rotate as needed. If there's good news and good developments in the company, you should absolutely stay invested in the company. I've definitely made my share of mistakes getting out of a company too early and then missing out on, future gains, and I've learned from those mistakes. So as long as IBM, I think the story stays good and they keep moving in the right direction, I will be staying invested in this company. Another thing Lynch said that I really liked was that the true contrarian waits for things to cool down and buys stocks that nobody cares about, especially those that make Wall Street yawn, which I think you can apply to IBM right now. It's not talked about at all. No one's really getting excited about IBM. I mean, you probably can't even find that many videos on YouTube talking about it. That's how you're able to find my video on it. Speaking of which, if you're enjoying the videos so far today, please don't forget to like and subscribe to the channel for more content. It really helps out. So yeah, IBM is definitely a turnaround play. What are some of your favorite turnaround plays? Let me know in the comments below. What IBM is doing right now to restructure and spinning off the less profitable segments will help maximize shareholder value. They're going to rid themselves of these, certain subsidiaries that are not as high performing, and this will enable IBM to become a growing company once again. At the same time, spin-offs are also good because when my shares split, I'll own a portion of IBM and then Kyndryl, the spun-off company. I will plan to hold both because parent companies usually set up their spin-offs for success. They usually have a strong balance sheet, they're well prepared, and it'll be interesting to keep an eye on, especially to see if there's, some heavy insider buying. That's always a good sign. Now, I think IBM has got itself a nice niche here. The new company is going to be primarily focused on this cloud, hybrid cloud, AI, and quantum computing, which these aren't things that anyone can just walk in and, start a business doing. Obviously, they do have some big competitors in the space, Microsoft, Amazon, Google, and many others, but IBM's been around forever, and I don't think you can count Big Blue out. Now, if we look at this chart here, you see that IBM's earnings have gone down quite a bit here, and this is definitely something to keep an eye on, at least its earnings per share. But if we do look at their revenue here, revenue in this last quarter ending March 31st was up almost 1% year over year. Nothing crazy, but it is a small step in the right direction. Now, revenue did still decline 3.6% year over year, and it has been declining for the past few years. This is not an investment that's without risk, but I think it's a calculated risk, and if IBM can keep paying down that debt and, making the right acquisitions, expanding in the high growth, high margin industries like cloud, I think the company is going to do well. Now, even though these growth rates, let's say their revenue is up 1% year over year, it doesn't sound like much. But if you accompany higher profit margins with cutting costs, let's just use the example and say a company has a 10% profit margin and they're able to grow that margin by 2%. That would then mean that their earnings would be up 20%. So these seemingly small and insignificant changes, they may not sound like much, but over the long term, now just imagine if they're able to continue growing year after year, a small percentage, moving the needle 1 or 2 percentage points in the profit margin per year, then they can increase their bottom line drastically. So this is a company, I will definitely be rechecking the story and make sure everything is still on track, but I think it's going to turn out well. Let me know what you think of IBM in the comments below. This is Vinny from the Investment Club, and I'll see you next time.